Okay, welcome back to chapter 12. And in this chapter, we are going to look at net operating loss and AMT, example of an AMT calculation, alternative minimum tax. Let's see how we can make it easy, not that much complicated. AMT normally will be calculated by your software. You don't do a manual calculation for AMT. It is it's not that much fun to do that. But we will look at an example of AMT calculation in your book to kind of get the idea how to do this. Okay, so let's go. This is the learning objectives, but let's go forward and see the first part, net operating loss. So this net operating loss by itself, it's a rule that has been changed so many times. By the time you try to learn it, they change it again. And the rules are constantly kind of getting edited. So I'm going to try to go over this net operating loss situation, but hopefully not, you don't get lost in between of these rules. So it's a special rule applies when individual business owners and C corporations report a loss in 1 year and profit in other years. So remember, we are not talking about S corporation. We are talking about C corporation. So C corporation files a tax return and pays taxes himself as a C corp. But in some years, maybe you have a loss. Some years, maybe you have a gain. Okay. If you have a gain, profit, then you pay taxes. If you have a loss, then you carry forward your losses. Same thing in individual business. As a individual, if you have a business, same thing. If you have a profit, you pay taxes. If you have a loss, there is a rule to carry forward this loss. So hopefully you can use it in future against your other incomes and, you know, kind of write it off and pay less taxes. So it would be unfair if business profits were always taxed, but no tax relief was available when the business is suffering a loss. The net operating loss provisions permits businesses losses to offset income from other tax years. So that's why they carry forward. For taxable years beginning before 2018, okay, before 2018. The carryover rule was back 2 years and forward 20 years. That means you can go back for 2 years and amend your previous tax returns and write it off, those losses that you incurred. Other than that, you can go forward up to 20 years and use it in future years against your income and write it off. So for instance, an individual with 2017 net operating loss would carry this loss back to 2015. We said 2 years, right? So 2015. He or she would recalculate the 2015 liability as if the deduction had been included on the original return. The recalculation would result in a refund of 2015 taxes. If the net operating loss exceeds the 2015 deduction, then the taxpayer would recalculate 2016 income. That means you have to amend that and see how much tax you can get back from 2016. If the net operating loss exceeded the amount used in both 2015 and 2016, then the taxpayer would carry forward to 2018 and next 20 years. Technically. One more thing. In net operating loss incurred before 2017 can offset 100% of the taxable income in each carryback or carry forward years. So you can offset all of your income up to 100% using your net operating loss in any of those years. But that's just before 2017. When a net operating loss is carried back to a prior tax year, the taxpayer completes and files a Form 1045 application for tentative refund to recompute the taxpayer's liability in the carryback year. Alternatively, taxpayers can elect to forego the carryback and carry forward the net operating loss 20 years. Then carried over to another year, an individual taxpayer treats net operating loss deduction as a deduction for AGI. So it will be above the AGI number on Form 1040. Okay, now it gets more complicated. The tax cut of 2017 amended these rules. Under the new rules, the net operating loss generated in tax years ending 2017 must be carried forward indefinitely, but not carrying back. So no more carrying back. In 2017, probably starting 2018, only going forward, no back. But going forward, how long? Indefinitely. Not 20 years, but indefinitely. However, the CARES Act of 2020 modified these rules so that they do not take full effect until 2021. So it gets more complicated. For losses incurred in 2018, 19, and 2020, there is a 5 years carryback period. Okay? So that's why I said don't memorize anything, because by the time you memorize something, they're going to change it. So all you need to know is just get to this point when it's necessary and study that specific rule and apply to your situation in your client's tax year. So 2018, 19, 20, all of a sudden, they have 5 year carryback period. We never had 5 year carryback period. We had 2 years back, 20 forward. Then they said, no back, all forward. Then they said, 2018, 19, 20, 5 years back. And then forward. Okay. The net operating loss rising in tax years beginning after 2017, which is 2018, is limited to 80% of taxable income. So before 2017 and before, it was 100% applicable to cover all your profit. But now it is only up to 80% of your taxable income can be written off. The rest carry forward again. And the reason they did that, because they want you to pay a little bit of tax no matter what. You cannot just write off the whole profit 100%. Any taxpayer who is carrying losses forward from 2017 and earlier years offset up to 100% of taxable income in the deduction year. So if you are 2017 or early carry forward, you have it, no problem. Still, you can apply 100% to your income. But anything after 2017, if you have any carry forward loss, business loss, only 80% will be applicable. 80% of profit you can apply. Only when all pre-2018 net operating losses have been exhausted does the taxpayer claim post-2017 loss deduction. So if you have any loss, net operating loss from your business from 2017 or earlier, first you have to exhaust that. After that is completely exhausted, which is also applicable up to 100%. After that is completely exhausted, then you start your new era, which is starting 2018 and forward. And at that case, only up to 80% of that will be applicable. 80% of profit of that year will be eligible to write it off against the net operating loss that you are carrying forward with you. Are we good? That was a lot of information by itself. Okay. How to calculate net operating loss? Here it says how to do it. But I think instead of reading this and leaving you more confused, it's better if we can find an example. But of course, you are free to read this. We might come back if needed, but for now, let's go to an example. Okay, are we ready? Here is the example. Chris and Donna are married and file a joint return. Chris operates a business that generates $120,000 of revenue and $150,000 of expense. That by itself means $30,000 net loss from that business. The Boskis report negative taxable income of $32,200, and this is how you get that number from. Salary, W-2, or whatever it is, $15,000. Business loss, $30,000 loss, which is 150 minus 120. They have net business capital gains. Net business capital gains comes from, selling equipment of business or something like that. $30,000. Net non-business capital gains coming from a non-business related gain. It might be personal investment or something. $4,000. Interest income, it's also non-business. $1,500. So out of here, please look at what is non-business. These two are non-business. You see that? Okay. AGI ends up to be what? 15,000 minus 30,000 plus 3 plus 4 plus 1,500 ends up to be minus 6,500 adjusted gross income. So far, so good. Less itemized deduction. This person, family of two, married filing jointly, they did itemized deduction, which is mortgage interest and real estate of 19,500, and something that normally is not permitted until end of 2025, unless it is a declared disaster area. So in this case, they have on Schedule A, they have casualty loss sustained in a disaster area, and because of that, they are permitted to put it in Schedule A, and that's $6,200. Let's say if they are not itemizing. If they are not itemizing, then what do you do? If you're not itemizing, what do you have instead? Standard deduction. So you put standard deduction over there, okay? But if you are itemizing, then you put your itemization. Okay, so because this itemization is bigger than standard deduction for year 2022, let's say, so they end up by using that itemized deduction, $25,700. So AGI minus 65, less itemized deduction of, let's say, 25,700. So taxable income ends up to be how much? Looks like 32,200, right? Okay, but we are trying to calculate net operating loss. How much can we carry forward? Okay, remember, from year 2028 and later, we need to carry forward indefinitely. Okay, but what is our net operating loss? Here we go. Taxable loss, as you see here, is 32,200. Here there is a typo, so it's 32,200. Okay, it's a typo, so it's not 22,200. It's 32,200. So keep that in mind. What it should be. Now, you have to add back something to this to figure out what is NOL, net operating loss. You added back any non-business related deduction that you have over there, because you want to, what are you trying to calculate? You are trying to calculate business net operating loss, okay? Not personal net operating loss, business net operating loss. That's why any deduction that you did before, you have to get rid of that. So you see here, I highlighted those, I believe. So that's 4,000 plus 1,500, that's non-business. That's a gain. So here you say minus. And net non-business deduction, let's say that mortgage interest and real estate, you add that back also. Imagine you were not itemizing. What would you add back here? Standard deduction, okay? Don't worry about casualty loss from disaster area. That is not in this calculation whatsoever, so just ignore it. That happens just once in a while for just a specific place that federal government is declaring as a disaster area. So forget about that. So either you use, let's say, standard deduction or itemized deduction. If it's itemized deduction, use it here, add it back. If it's standard deduction, then add it back. Any non-business income, take it out of that scenario. If it is non-business loss, add it back. Okay, just like deduction, non-business loss, add it back. Non-business income, take it out of that calculation. So bottom line, 19,500 less 5,500, it's how much? $14,000. Put that $14,000 all the way to the right column. Here you see it's 4,000. That's wrong. It should be 14,000. That's a typo again. So we have two typos here for some reason.
So is that 18,200 also wrong?
No, 32,200 less 14,000 that we just calculated, right?
Mm-hmm.
Ends up to be 18,200. So 32,200 minus 14,000. It's 18,200. And that is your net operating loss. Finally, after all this calculation, that is the net operating loss that you're going to carry forward indefinitely to use it for the next coming years against your business income. right? Against in your, let's say if you are an individual in your form 1040, I think you go to line other income and you use it as you in the dot. Let me show you form 1040 so you see what I'm trying. Form 1040. Okay, so this is form 1040, let's say for 2022. So here, you see that line 8, other income? That's where it goes. Yeah, and in the dotted area, which comes from Schedule 1, honestly, in the dotted area will be NOL, and then you show here minus 18,000, whatever it was, 18,200. But don't forget, after 2017, starting 2018, that is limited up to 80% of your profit. Make sense? That means you cannot write all of it 100% against the income that you have. Up to 80% you can write it off. Yes, 2017 and before, it was 100% you can write it off against your profit. But after that is up to 80%. The remaining carry forward indefinitely. Okay, so that's kind of.
If that was the case, if this was after the time frame, it would be 80% of this 18.
Because this is 2022, that means it's after 2017, 18, 19, 20, 21, 20. So it says up to 80%. If you go to previous page, I remember here. Net operating loss arising in the tax years beginning after 2017 is limited to 80% of taxable income. So next year, let's say your taxable income is $100,000. If your taxable income is 100, let's make it 10,000 so it's easy. Let's say your taxable income is $10,000. Okay, what is 80% of $10,000? $8,000. But how much do you have in this example? 18,200. So you can write it off up to $8,000. The $10,200 you carry forward again. Keep doing that till you get rid of that net operating loss sometime in future. Make sense? And again, software will do it for you. Software will never write it off 100% for you because software knows already when they program it, they know that this is 80% rule because it's year 2022. So that was a good example. Yes, it had 2 typos, but just fix that typo in your brain. So here is the 2,200, which is coming from here, and then 14,000, which is coming from here, and the answer is 18,200, and you carry forward. Here it says, in this example, the Bosques would report 18,200 as negative amount on the other income in their 2020 tax year tax return in the manner that 2023 form applies. Here, I just show you 2022 because I think 2023 is not ready yet. But anyway, that's what it is. It goes in other income with a minus. And you have to, in the dotted area, in your software, it's you make sure that it shows NOL, net operating loss. So IRS knows, oh, that's a net operating loss. Again, if you are using the same software that you used previously, the software will put it as NOL itself. But if it's a new software, you have to make sure those things get done right and properly. In regards to excess business losses, the Tax Cut Job Act of 2017 introduced a limit on deductible business losses. Non-corporate taxpayers are not allowed excess business losses for tax years beginning after December 31st, 2017 and before January of 2026. That was the Trump tax change. However, the CARES Act of 2020, that's when the Biden era came, retroactively deferred its applicability until taxable years beginning after 2020. Therefore, taxpayers who have filed 2018 returns with these limitations need to amend their returns to claim the maximum deduction permitted as a result of CARES Act. So, an excess business loss is the excess of this situation. The taxpayers aggregate deductions for the tax years from the taxpayer's trade or business, determined without regard to whether or not such deductions are disallowed for such tax years. Under the excess business loss limitation over this, the sum of either A or B, the taxpayers aggregate gross income or gain for the tax years from such a trade or business, or that limitation. So that's $250,000 adjusted annually for inflation. So anything above that is excess business loss and is not permitted. So if you have like in this $250,000, it's kind of the threshold that you are looking at, but every year is changing. For a single person is 250, for a joint return is 500,000. But then in year 22, based on inflation is changing again. Year 23 will be also changed again. So every year is changing, but that's a threshold. And again, your software will be updated properly for that threshold on an annual basis. Okay. Let's look at this alternative minimum tax rule. It's hard to explain. We gotta go to look at an example to make it a little bit more manageable. So the tax law contains many exclusions, right? And alternative minimum tax is saying that you need to pay some taxes no matter what. And if you are having a lot of deductions and exclusions and so much that you end up paying so little tax, IRS doesn't like that. Says you have to pay a certain amount no matter what. Even though I know you are rich and you have so many deductions and exclusions and everything possible, which is okay, but you need to pay at least some certain amount of tax. So people who have high income, they end up paying what? AMT taxes, because based on their situation, they might have a lot of exclusions and deductions and whatsoever. And it's not fair to give them that much break. So we say, yeah, you can afford, based on our calculation, you can afford to pay a little bit more tax, no matter what. So here is the calculation. So it says, whatever your regular tax income is, you add standard deduction to it. Add the net operating loss deduction that you just used to it, you add tax preferences and positive adjustments to
What does
it.
that mean?
Huh?
What are tax preferences and positive adjustments?
A lot of things. A lot of things. We might look at it next few pages. And then I'm gonna take you to an example because it's gonna be much
The other
easier.
thing that's confusing is why are you adding a deduction and not you deducting a deduction?
Yes, because they want to know how much you really here, alternative minimum taxable income. How much you really taxable income have.
So you're putting that stuff back, like, you're not getting the deduction, you're not getting this, you're not getting that. You're adding all those things back in.
Yeah, you're adding all this back in to say, okay, I know your taxable income is this, but if we add back all this stuff, how much really taxable income you have? Then you come up with that number, whatever it might be. And then the IRS says, because I'm so generous, I'm gonna give you remember we have a standard deduction for Form 1040, something like that. They give you an AMT exemption. I put it with the green color, that means it's a good thing. They give you an AMT exemption and they say, okay, take that out as a so-called, holiday gift. Now tell me how much AMT base do you have, which is red color. Now that we know how much AMT base you have, we're gonna tell you multiply that with a tax rate that we give you for your AMT tax calculation. So you end up with the tentative minimum tax. That means that's something that you have to pay no matter what. Your regular tax, it is what it is. You take it out of that minimum tax, AMT minimum tax. The difference, we call it AMT tax. Got it? Now, how you calculate that, we look at an example of this. Someone asked, what is the preferences and adjustments that you are talking about? Here we go. There are things like bonus depreciation or something like that. So what type of things did you use in order to accelerate your deductions during the year? So you have to kind of do some adjustments based on those. So here's several adjustments and preferences used in computing AMT rate to calculation of taxes. So what are those? Maybe we can see some of those in the next page. One of them is the depreciation. So depreciation, they like you to use a specific type of depreciation, not accelerated depreciation or something like that. So the regular income tax permits taxpayers to immediately expense Section 179 or use an accelerated method of 200% balance declining and bonus depreciation if available. To depreciate tangible property, personal property. The AMT system also allows this Section 179 and bonus depreciation, but can require a slower depreciation method or longer recovery period. Two common depreciation adjustments are for real estate property. So if you have a real estate property purchased in 1987 and 1998, using straight line of 40 years, that's one thing that AMT wants to adjust. Depreciation of personal property, AMT uses 150% declining balance That means a slower depreciation. What is a straight line depreciation? Straight line depreciation is 100%. Double declining is fast, 200%. So AMT using 150% is fine. Okay, so there's an example here. Maybe we read one of them. Let's see. In 1995, Nadia and team paid $430,000 for a ski villa in Aspen. They use solely as rental property. They depreciate the villa using makers straight line over 27.5 years, which is correct. That's residential property and should be 27.5 years. Each year they deduct $15,636, which is total cost divided by 27.5 years. For purpose of computing AMT, depreciation allowed is $10,750, which is longer period of time. They don't like past 27.5. They like 40 years. So they permit you only how much? $10,750. Therefore, during the years that makers is deducted in computing the owner's taxable income, they must add back to taxable income $4,886 excess depreciation compared to 40 years to compute AMTI. After the property is fully depreciated under makers, the owners can continue to take depreciation deductions when computing AMTI. This will result in a negative adjustment. So up to 27.5 years, they get, this family, they get kind of, penalized. But after 27.5 years, they get happy again because they have still some form of depreciation based on 40 years when calculating AMTI. This will result in a negative adjustments in those years after 27.5 years. Negative adjustments are subtracted from regular income when computing AMTIs. So this family for first 27.5 years will be pissed off, but after that they will be happy and they say God bless AMTI. Some fact, same facts as example 2, except the owners bought the villa in 2002. For real property placed in service after 1998, there is no difference in depreciation rules for computing taxable income and AMTI. Therefore, no AMT adjustment is needed. Okay? So if it was before 1998, because they bought in 1995, they have to follow that available 40 years option. But because they bought it after 1998, so then that 40 years option, it was not available anymore anyway, so that whatever it is, 27.5 years is fine. In 2022, a taxpayer buys used business property that costs $30,000. The half-year convention applies to the property. The recovery period is 5 years for regular income tax purposes. So it's a 5 years property. It's 8 years for AMT. So 5 years for regular tax, but longer for AMT. Depreciation for regular income tax, 200% double declining over 5 years, is $6,000 in year one, which is, if you look at the table, is $30,000 times 20%. And why is 20%? because it's half-year convention. Remember? First year, it's half-year convention. If it was not half-year convention, would be what? 40%. How do you know it's 40%? Very easy. 100% of your property divided by 5 years life. 100% of your property divided by 5 years life is 20%. 20% times double declining, which is 200%. So 20% times 2, it's 40%. So it should be 40%, but half-year convention is applying. So half-year convention, that means 40% divided by 2 in the first year. And therefore, it will be only 20%. So 30,000 times 20% is 6,000 using 200% double decline. AMT depreciation is 150% double declining, so it's not that fast. Also, it's longer, which is 8 years, just for AMT calculation, okay? Nothing else. So that will be $30,000 divided by 8 years times 150%, half-year convention. So it ends up to be $2,813. So that $3,187 difference is added back to taxable income in computing AMT. You're good? Okay, don't get higher. There is also some rules for passive losses. Neither the regular tax nor AMT system allows for passive losses in excess of passive income to be deducted in the year they occur, which is correct, right? We know that. Such losses carry forward and offset passive income in future years. I'll give you an example. I had passive loss for many years. I couldn't use it. And I was technically carrying forward till 1 year, let's say starting last few years, I got some portfolio income, which is passive income. And that passive income all of a sudden was increasing my taxable income, right? I have to pay a lot of taxes. But then I realized that my software is still remembering that I have passive carry forward loss. So based on that, my software was applying that passive carry forward loss to my passive income, and I saw that my tax went down a lot, and I was so happy, right? So that passive loss you carry forward, it comes handy one day when you have a portfolio income or something like stock investment income, something from that, and it will help you. So such losses carry forward and offset passive income in future years. Any losses carried forward are deducted in full when taxpayer dispose of the entire interest in the activity. Okay, why the loss recognition for both tax calculation is deferred? The amount of the loss to be deferred will usually differ. The difference occurs between the loss of AMT purpose is determined using the required AMT tax adjustments rather than regular income tax deduction. For example, Makers depreciates residential realty over 27.5 years using straight line method. For AMT, this property is depreciated over 40 years if it was placed in service before 1999. Because this difference affects the amount of passive loss carried over for regular tax versus AMT, it will affect the amount of recognized gain when the property is sold, as well as the passive loss deduction amounts. Okay, so that's passive loss kind of thing that we just covered. I want to go to next, an example for AMT. AMT here is talking about itemized deduction and taxes and interest. You can read that. We will kind of cover that when we get to the example. Remember I said AMT has an exemption given by IRS as a holiday gift, just like standard deduction in the 1040. Same thing, we have AMT exemption. So AMT exemption is, let's say, for married filing jointly, is $118,100, and it will phase out by some certain calculation, which is $1,079,000 times 25%. Okay, whatever it is. So I just want to tell you that there is an exemption, and that the exemption changes if you are single or married or filing separate. Okay, let's go to an example, hopefully. Okay, let's do one of these examples first. I'm looking for the big AMT example, but before that, we do one. Jess files a separate tax returns. Let's do joint return, this one. Rocky and Randy Kane file a joint return. Their 2022 AMT is alternative minimum tax income is $1,393,000. The Kanes compute the AMT exemption as follows. Initial exemption is $118,100. We know that. Alternative minimum tax income is $1,393,000 of income. So they make a lot of money, right? Less AMT threshold for married filing jointly is $1,079,000. So the excess is how much? $313,000 of excess. Excess of that 1 million. Okay, times 25% phase out percentage ends up to be 78,000 phase out. Minus 118,000 exemption. So the only exemption these guys get is only $39,800. Okay, and why? Because they are rich. For me, the initial AMT exemption is $118,100. For these guys, is $39,800 because they make a lot of money. Make sense? So if you make a lot of money, that exemption that I said IRS gave you as a holiday gift, just like standard deduction, it will go down. You're not going to get that much big gift to accept. Okay, the AMT rates. What is the tax rate anyway? The tax rate for AMT, it's a two-tiered rate schedule is used to compute the AMT. The tax rate on first $206,100 of alternative minimum tax income in excess of allowable exemption, which is $118,000, is 26%. A 28% rate applies to the excess of that. So up to first $206,000 above exemption is 26%. Anything above that, 28%. The AMT rate do not apply to net capital gain and qualified dividends. These amounts remain taxed at the taxpayer's blended tax rate and not the zero rate that generally applies beginning in 2018. Remember, net capital gain has zero 15, 20. That's what this is talking about. Continue with example 10. Kane subtracts the AMT exemption from alternative minimum tax income to arrive at the AMT base, which is 1,393,000 minus 39,800 that we just calculated, is $1,353,200 taxable income. The Keynes tentative minimum tax equals to 206,100 times 26%, and the rest times 28%, which is $374,774. If this amount exceeds the regular income tax liability, then the excess is alternative minimum tax. So that means they have to pay minimum $374,774, no matter what.
So at what point do you start going down the alternative minimum tax, like rabbit hole? Like how do you decide to figure that out?
First of all, every time you prepare a tax return, the software is calculating AMT for you every time. If your taxable income is less than AMT, automatically you will see that AMT will pop up into your 1040 and says, no, you're not going to pay that. You're going to pay this because your taxable income is less than AMT. Like this family, they're going to pay $374,774. Make sense? Minimum. Let's say the tax is $350,000, for example, right? For this income. Software will say, hey, your tax is $350, but you're not going to pay that. You're going to pay $374,774.
Is it obvious when you're doing it?
Yeah. You see that it says AMT calculation added to the whatever it is the remaining, and here you have to pay this amount. There's a worksheet. Like in my tax return, normally I end up by paying a little bit of AMT. Not too much, but a little bit. I end up. If my income was a little bit less than whatever it is, I would not pay that AMT. I wouldn't get to that point. But since I'm passing that, so I end up by paying a little bit of AMT.
Does that mean a lot of your work is 1099 and not?
No, it's not about that. IRS says to me, hey, few years ago, you were not making that much money, but now you are making a little bit more money than you were doing before. So you deserve to pay a little bit more taxes than whatever you did few years before. So you have to pay alternative minimum tax, at least this amount. Because your calculation in your tax return, the way you did it, you are not paying at least that amount. So because of your income is high, then you have to pay. So the calculation, it says you remember the first box I was showing you on page maybe 12- maybe 2, I think. That one, yeah? No. This one. You see, the software will say, okay, your regular taxable income is this, and you pay whatever tax you need to pay based on tax date. Yes, but in the same time, behind the scene, software is calculating your AMT. And if your AMT is bigger than your tax that you are supposed to pay, then AMT gets ahead of your tax and you have to pay this. But you have an exemption, okay? So AMT normally gives you an exemption unless your income is a little bit higher than it is, higher than 1,079,000 for maid filing jointly. And at that situation, you end up with some limitation like this family, like Rocky. Rocky exemptions is not 118 anymore, it's 39,800. And based on that, we just calculated that Rocky has 1 million here, 393, right? Minus exemption has $1,353,000 of taxable income for AMT purposes. And we multiply that with 26%, a portion of it, and 28%, the remaining balance of it. We end up to be in, $374,774 of tax that the Rocky has to pay no matter what. Okay, let's go to an example before we finish it. I'm gonna finish it hopefully to this part, and next time I don't think we're gonna have that much thing to cover. We will at least prepare tax return, which is much more important right now. Okay, AMT. Let's go step by step. Stay with me. Here we go. So Jeffrey, single, age 47, calculates his regular tax liability for 2022 as follows. Salary, $95,000. He has rental income, but against rental income, he has depreciation, interest, property tax, other expenses. So he ends up by having $9,000 of expenses for the rental property. So $6,000 less $9,000 expense is $3,000 loss from active participation in this rental property that he's managing. Okay. Also, he has short-term capital gain on the sale of stock, like everyone has nowadays in a portfolio. So that's $5,000 gain. So 95 minus 3 plus 5, adjusted gross income, $97,000. Very good. Less itemized deduction or standard deduction. So let's say itemized deduction is charitable contribution, home mortgage, real estate tax. Total Schedule A is 39,400 minus 97,000 AGI gives us taxable income of $57,600. Then our software will go ahead and show us $8,295 of taxable, tax liability, $8,295 tax liability. Very good. That's a normal tax return, okay, so far. Jeffrey used accelerated makers to compute depreciation. Had he depreciated the property using the AMT depreciation rules, he would have deducted only $2,200 for real estate property. How much did he use? 2,400. You see that? And 450 for personal property. Here is 600. Jeffrey received $41,500 in next tax-exempt interest from specified private activity bond he bought in 2004. It's tax-exempt, so it's not showing here. He also paid $30,000 for $50,000 of stock through an incentive stock option plan set up by his employer. So he paid $30,000 for something that has technically $50,000 fair market value. Using this information, Jeffrey's AMT is something else, 8,000, alternative minimum tax is 4,000, compute as follows. So regular taxable income is 57,600, which is coming from here. Excess depreciation, it was 2,400, but technically under AMT is just 2,200, so that's $200 excess. For personal property, it's $150 excess. So we add them up, 350, we're gonna add it to 57. Disallowed itemized deduction. Real estate taxes are disallowed for this purpose, and we add it back. Private activity bond, yes, I know it's tax exempt, but it's income no matter what, right? So let's see, $41,500 there. Stock option, he bought it for $20,000 cheap compared to whatever it's supposed to be. Technically, that is also an income. So we try to really see how much this guy is making, okay? So his alternative minimum tax income is not 57, but 123,850. But as a single person, IRS gives him a very nice gift of AMT exemption of $75,900. Therefore, also there is no phase out because he's not making millions of dollars. So there's no phase out. So the whole 75,900 gonna pop up in here. So 123 minus 75, AMT base finally ends up to be what? 47,950. AMT rate applies to this 26%. 26% of this up to 206,000. Remember, that's the threshold. So this is way below that. So 26% of 47,000 is $12,467 tentative minimum tax. Okay, he's already paying how much here? $8,295. But we gotta tell him, hey, you gotta pay that. But remember, there is an alternative minimum tax also applicable. So that will be added. So you end up paying $12,467 at least.
So basically, what they're saying is tax exempt is really not tax exempt because you're gonna get charged on it on the.
It is tax exempt, but you get to a point that you are making a little bit more than a low income person, and when we calculate your AMT, a little bit of that exempt that we were giving to you ends up being taxed.
Well, it's tax exempt for low income, but when you make over a certain amount, you're getting taxed on
Yeah.
at a lower tax rate.
Yes. So remember I said previously myself, I was not making that much money, so I was not paying AMT tax. But now that I'm making a little bit more money, IRS says, okay, it looks like you're doing good nowadays. Okay, so let's contribute
That
to.
threshold seems a little low, looking at these numbers, like alternative minimum tax on someone making $100,000, like you can't even,
Not in California.
not by yourself.
But he's single. For me, it's not $75,000 exemption. For me, it's $118,000 exemption because I'm married. But anyway, yes, after certain limit, the guy says, okay, if someone making $40,000, it's fine. I'm not gonna go after him. But you are making $150,000, you can pay a little bit more taxes. So your AMT will be this much. And please contribute to the society. So that's what we do.
We live in LA. You can't be.
Yeah, you really can. Not over $100,000.
But just so you know, coming from someone from Middle East,
Yeah,
I'm happy to pay taxes because against that taxes, I have so many things that I don't have the same thing in the Middle East. yes, in the Middle East is a little bit, now, they don't come after you exactly like this to collect taxes. But in return, you lose a lot of things that you deserve to have.
Right.
But when I'm here, yes, everyone is paying a little bit more specific taxes, but end of the day, we have 911 and I call
Nice
them
roads
5
to
minutes
drive
later,
on.
they're gonna show up here.
Police and-
So there are things that maybe you don't appreciate that because you are living here forever and you don't know what's going on. But from my perspective, I always said, this is when I came to this country, they said, this is not a good country. I said, what? They said, oh, you pay a lot of taxes. I said, I wish one day I write $1 million check for IRS. If you are trying to skip taxes, I like to pay taxes. I like to pay $1 million check to IRS, and that's my wish. So still, I didn't come true, but that's where I like to go. To a point that on April 14th, I like to write $1 million check to IRS. That means I'm making a lot of money.
Yeah.
That's what it means. So don't worry about paying taxes. You should be worried how to pay more taxes.
I hear what you're saying.
Make sense? So focus on the positive side of the picture instead of negative side of the picture. So that's what it is. Have a wonderful day. Next time, hopefully we can prepare some taxes.